VTI is the Vanguard Total Stock Market ETF. It is one of the simplest and most powerful investments for long-term wealth creation. The goal of VTI is to give you exposure to the entire US stock market, not just the top 500 companies like the S&P 500, but every publicly traded stock in America. That includes large-cap companies like Apple and Microsoft, mid-cap names like Etsy and Chewy, and small-cap stocks you have probably never heard of. In total, VTI holds over 3,500 individual stocks across all sectors and sizes. If the company is publicly traded and based in the United States, there is a good chance VTI owns it. That is the power of total market investing. One ETF gives you instant diversification across the entire American economy. Now let us talk about how it works. VTI is passively managed and tracks the CRSP US Total Market Index. It is a market cap weighted fund, meaning the largest companies make up the biggest portion of the ETF. Right now, the top holdings include Apple, Microsoft, Amazon, Nvidia, Meta, and Tesla. These 6 companies make up over 25% of the entire fund, but you are still getting exposure to thousands of smaller companies as well. This balance helps smooth out returns. When small caps are struggling, large caps carry the weight. When large caps slow down, small and mid caps often outperform. Now let us talk about income. VTI pays a quarterly dividend. The current yield as of 2025 is around 1.4%. That means for every $1,000 you invest, you earn about $14 per year in dividends. It is not built for income, but the dividend is a nice bonus. The more important value is total return. Over the past 10 years, VTI has returned an average of around 10% per year, including dividends. That means if you invested $10,000 a decade ago, you would now have over $25,000. The reason it works so well is because of compounding and low fees. Let us talk about fees now. VTI has one of the lowest expense ratios in the ETF world at just 0.03%. That means for every $10,000 invested, you pay only $3 a year in management fees. That is basically free. It is lower than 99% of mutual funds and most ETFs. When you compound that over decades, the savings are massive. You get to keep more of your money working for you. What about risk? VTI is a stock ETF, so it is subject to market risk. When the market drops, VTI drops. But because it is so diversified, it tends to be more stable than individual stocks or sector ETFs. You are not betting on one company or one industry. You are betting on the entire country. If the US economy grows over time, so will VTI. That is the long-term thesis. You do not have to guess which stock will win. You own them all. What about volatility? VTI has a beta of about 1, which means it moves roughly in line with the overall market. It is less volatile than small-cap funds, tech-heavy funds, or speculative ETFs. It is not immune to losses, but it is resilient. During downturns like in 2020 or 2022, VTI took a hit, but it recovered because the entire market recovered. You are investing in the system, not the outliers. Now let us look at the income table. If you hold 100 shares of VTI at a price of $220, you will earn about $1 per share annually in dividends. That is roughly $25 every 3 months. If you own 500 shares, you will earn around $125 per quarter or $500 per year. 1,000 shares will generate about $1,000 annually in dividend income. Again, the primary purpose of VTI is growth, not income. But those dividends still add up over time, especially if you reinvest them. Now, how does VTI compare to other ETFs? Compared to VOO, which tracks only the S&P 500, VTI offers broader exposure. That means you get the benefit of small cap and mid cap performance during bull runs. Over long time periods, VTI and VOO have similar returns. But in some years, VTI outperforms due to gains in the smaller segments of the market. Compared to SCHB from Schwab or ITOT from iShares, the differences are minor. All 3 offer total market exposure, low fees, and high diversification. You cannot go wrong with any of them. But Vanguard's reputation for long-term investing and customer focus gives VTI a slight edge for many investors. What is the best way to use VTI? Simple. Buy it regularly and hold it for decades. It is perfect for dollar cost averaging, retirement accounts, or as the core of any investment portfolio. You can pair it with a bond ETF for less risk, or just go 100% VTI if you have a long time horizon and a strong stomach for market swings. It is the ultimate set it and forget it investment. Now for my meter rating. Income gets a 5 out of 10. The dividend is consistent but low. Risk gets a 6 out of 10. It moves with the market but is well diversified. Sustainability scores a perfect 10 out of 10. This fund will still be relevant 50 years from now. Upside potential gets an 8 out of 10. While not explosive, it delivers long-term compounding at scale. Ease of ownership scores a 10 out of 10. It is one ETF to rule them all. My final score is 8.6 out of 10. VTI is the definition of a long-term core holding. If you want simplicity, diversification, and growth without overthinking your portfolio, VTI is one of the best ETFs you can buy. If you have any videos you would like me to cover, say it in the comments below and I will break it down in plain English.